Welcome back to Financial Fortitude. I'm Michael Acosta here with my co-host, Brady Hemmerly. Today we're diving into a question that's on a lot of minds. Am I on track for retirement based on my current age? Whether you're just starting out in your peak earning years or closing in on retirement, we've got actionable insights for you.
And before we jump in, make sure you hit that subscribe button, leave us a review, and share this episode with anyone who could use a little financial guidance. Your support helps us reach more people looking to balance living well today with planning for a successful future and retirement.
All right, Brady, let's go ahead and get into it. Welcome to Financial Fortitude, a podcast for high earners, families, and business owners. We are your hosts, Michael Acosta
and Brady Hemmerly. Each week, we bring purpose-driven financial guidance to you so you can be assured you're on the right path. If you're looking to become an extraordinary wealth builder, let's dive in. I am very excited about this topic because I think it is a question that we get day to day, really no matter age, wealth, strata, kind of anything. Retirement's the big question on everybody's mind.
Yeah, retirement is the end game, right? I mean, we're working day in and day out for most of us. Some of us are employed by others. Some of us own our own businesses. And we're honestly just trying to squirrel away as much as we can in order to make sure that when we decide to exit the workforce on our own accord, that we can live a lifestyle that we desire, that we dreamed of during our accumulation years. And if we're not prudently prepared, then, things could look, unfortunately, different than what we had hoped for when we decide to go into retirement.
Yep. No, I would agree. I guess the question I have for you first and foremost is, as you are speaking to friends, family, colleagues, clients, how many people are really spending time examining or looking through what does retirement in my life look like together, or am I thinking about this at all?
Yeah, that's a really good question because we recently looked at, in preparation of this conversation today, a study that was conducted by Nationwide. And one of the things that they are talking about in this article, which is entitled "From Coast to Coast, Americans Face Different Retirement Planning Challenges," is that over the course of the last 5 years, that 61% of investors feel as though their retirement expectations have changed significantly. And they break out this awesome chart that just looks at the entire nation and breaks it out into 4 different groups as far as West Coast, Midwest, South, and Northeast. And the area geographically of the U.S. that is, I would say, quote unquote, most impacted, or who feels as though their retirement expectations have changed the most, would be the South, right? With 65% of that 61%. So it's definitely on the minds of everybody. It's just a matter of how close are you to retirement, and do you have enough of a runway to make some meaningful changes so that your outcome looks different for your benefit.
Oh, I'd agree with that. I think that's the same sentiment or theme that I see is most of the clients that I speak to, really that we speak to, up until retirement gets more tangible, call it 5, 10, maybe 15 years out, it's much more an afterthought for people. It surprises a lot of people right before they get close enough to the finish line that they can see it. And then all of a sudden it's, hey, how do I kind of wrap this thing up with the time that I have left?
And I would even add that in speaking with other clients, even friends, like this idea of preparing for retirement just doesn't often sit well for many, because the way that it's approached or the way that it is presented is really by guessing into the future, which we can both agree isn't the best approach to planning for a successful retirement. There's just way too many unknown variables for us to be able to capture, and they just have to remain static. And you're basically running or conducting this analysis in a vacuum, which we understand isn't real, right? Even if we go back to that Nationwide report, again, just within the last 5 years, and think about what's taken place in the last 5 years, globally, domestically, politically, the whole 9 yards. And so you speak with a lot of young professionals or even pre-retirees, and it's like, hey, I've spoken with somebody in the past and they ran a needs analysis for me, and the sentiment wasn't great. And it's because the numbers in a vacuum don't always work in the favor of the individual or the family or the business owner.
So let's role play this a little bit then. If I come to you, or I'm a client who comes to us, our team, and I ask the question, hey, am I on track for retirement, or how well on track for retirement am I? What kind of questions are we asking people? What kind of things do we need to know? How do we start that conversation? Because the question's pretty wide, right? It's a very wide net that's being cast, looking for really specific answer.
Right. This is going to be fun. So often the baseline, the data that you actually need, surprising enough, isn't necessarily the assets that an individual or family or business owner has on the balance sheet. It's really, what is your monthly burn rate? Another way of saying that, how much money are you spending each month? How much money are you putting onto the balance sheets of somebody else? And second, how much money do you actually earn each month? How much money do you bring in? But the spend rate is really going to be one of the top variables that needs to be accounted for. Because if I don't know how much money you're spending today, how do I know how much money to replicate for you or replace or replenish in the future when you decide to no longer work? So your human capital is no longer there. It's a moving target. And in preparation of this conversation today, we were talking about analogies, and one that came to mind was, well, if we don't know what someone's spend rate is, it's almost like flying from the East Coast to the West Coast and flying blindly, which I hate to fly, so that would be a terrible flight for me. But we could at least head in the right direction while we're flying. We will definitely, hopefully, end up on the coastline of the West Coast, but we may be too far north or too far south, right? It's just not efficient. So again, step one is let's just figure out how much money do I need each month based on my current lifestyle? And a great question to then follow up with is how much of that do we need to replace?
And I think that's the biggest challenge for most people that we speak to, is if I ask someone, if I wrote you a check today and that check was going to show up on the first of every month, how much would you need on a regular basis to comfortably step away from work? The amount of people that say, I don't really know, is crazy. It's very much so like, hey, I really have no idea. And it's like, okay, well, let's start somewhere knowing we're headed from one coast to the other. But that's really the problem, right? Is figuring out where we are today, knowing we're going to be spending likely more in the future if inflation sticks around as it has and as we've seen. But yeah, getting there is the real challenge.
And when we get those questions of, am I on track? How much am I going to need when I retire? Again, I will be blunt and tell you, I don't normally prepare that type of analysis for clients just because I think it creates more anxiety or stress than what's necessary, because we're a firm believer in, hey, let's plan based off the data and facts that we know today. Let's plan moving forward as opposed to guessing into the future and mathematically working backwards. Now, with that being said, we're both certified financial planners. We know how to run a retirement needs analysis. So we will do it for clients and we will say, hey, this is what the static vacuum variables spits out, right, as far as the analysis goes. But let's not spend too much time on this, or let's not lose too much sleep on it, because this is more or less a target. Let's see if we can do better, or unfortunately, we might do worse, just depending on what life throws at us over the course of the next 10, 15, 20, 25, 30 years, right? So it's setting the expectation, satisfying the quench, but then managing the actual behavior and emotional sides of it from a behavioral finance perspective.
Yep. All right, Michael. So let's role play this a little bit, at least more specifically. So I've cast the big net, right? I've come in and said, can you help me or show me how on track I am for retirement? In this scenario, I'm in my mid-30s. I plan to work close to full retirement age, if I had to take a guess. I have about $500,000 in assets. I make pretty good money, and I spend a good chunk of money too, somewhere between $10,000, $12,000 a month. And I've invested the dollars that I've thus saved. Again, that $500,000. Am I on track? How close am I? What is that going to look like for me?
Yeah, so again, I'm not a huge believer in the retirement needs analysis, but to satisfy the quench, we put together a report. And for someone who's planning on working to full retirement age, who's in their mid-30s, that means that they're going to be exiting the workforce around age 67, right? If we're going to be specific, let's say that you're 34 years old today and you have about a 33-year working time horizon. Let's assume that over the course of those 33 years that the inflationary rate on average is going to be about 3.5%. And then also, while you're investing during this period of time, your existing assets, which are just over $636,000, are growing on average at about 8% over the long haul of those 33 years. If you're spending $10,500 per month today in today's dollars, when you get ready to exit the workforce and you enter retirement, that $10,500 is really going to feel like close to $29,000 per month.
I think this is where, as advisors, we get a little bit of pushback, because my first thought is going to be, there's no way I could spend $30,000 a month. That just seems crazy.
Well, in today's dollars, of course not. But if it's being inflated by 3.5% year over year over year for 33 years, then absolutely, right? I mean, it's something that has to be at least accounted for or considered. But again, one of the arguments or I guess objectives that you and I expressed earlier is that this isn't the best way of planning for the future.
No, and I think it really comes down to the fact that me, as the mid-30s young professional, maybe just started my family, I barely know what next year is going to look like, let alone age 67. So these are just numbers we're almost throwing on the wall at some point.
Correct. And it's just seeing what sticks. Now, that's just the first step in this retirement needs analysis. What I then have to calculate for you is trying to back into, okay, well, how much money do you need to enter retirement at the beginning of the year to where if you were going to live off of that $29,000 per month over the course of the rest of your lifetime, okay, and let's just say that that's roughly 29 years, that you basically spend down that balance or that account down to zero. And so we're going to guess into the future, mathematically work backwards. And if we're assuming a 6% return during our retirement deaccumulation phase or our retirement distribution years, well, we need to enter retirement with about $7.9 million.
Holy crap.
Yeah, no, if your eyes didn't get big, it's kind of like, okay, well, we could definitely look at the rule of 72, which is how quickly would your existing assets double? What would be the timeline for it to double based on an assumed rate of return? Well, during your retirement years, again, we're anticipating that we live a life of about 29 years in retirement with our investments growing at 6%, but we also have to account for inflation as well, right? So we're still assuming that there's a 3.5% inflationary rate during retirement. And if I told you first, hey, you're going to need to have $29,000 when you enter retirement. Oh, by the way, you're also going to need to have about $7.9 million banked up. And today you only have about $650,000. How does that make you feel right out of the gates?
Pretty discouraged. At least that's the sentiment that we see a lot of times. It's like, hey, well, thanks for telling me I'm certainly not on track.
Right. No, exactly. And one thing that we haven't discussed today really is, well, how much is this individual earning? But what this retirement needs analysis is going to show you in step 3 is, okay, well, how much do you need to be saving each month or each year in order to make sure that you're as close as possible to hitting that $7.9 million in retirement when you exit in your first year? And what the calculator spits out is about $3,400 per month. That comes out to just under $41,000 per year set aside on your balance sheet. If you're an extraordinary wealth builder, that means that you're earning about $200,000 per year.
Yep. In that case, if I'm earning 200, saving about 20%, call it the 40,000, I'm consistently living off of the rest. And at that stage, it all works out. But a $200,000 mark can be a challenge. At least, hey, I'm in my mid-30s. I'm just starting out. I'm not in my peak earning years, at least not yet.
Right. And I would even say during your peak earning years or even before that, somewhere between your mid-20s all the way up until your early 40s, we've talked about it in the past. Those are your highest capital needing years, right? Just because of the changes that you're going to experience in your life depending on what your trajectory career-wise looks like or, family-wise, right? You might be getting married. You might be having children. You might be buying your first piece of real estate. You might be starting a business. You might be completing medical school and then going through residency and fellowship training and then getting into practice, which could be anywhere from 3 years on top of, above and beyond medical school or as much as 7 years beyond medical school. What this assumes is that, okay, it's one thing to be saving at an extraordinary wealth builder rate, which is that 20% of annual gross income. It's another thing to keep those saved dollars on your balance sheet and not dedicate them towards other goals that you might have, right? Which would then just result in some sort of asset exchange, right? If you're taking money that you have saved up and you're exchanging it for, let's just say, your first home, that's going to be an asset exchange.
So, Michael, at this stage, we've had the needs analysis conversation. Me, as the client, and perhaps my spouse sitting next to me are now very discouraged. It feels like we're off track. The action to begin taking is, hey, we need to focus on saving because that's important. We're trying to build this runway. Now you have found that as we are discouraged, you step back in and say, all right, let's put some markers in the sand as to what we see as success, right? Knowing that that 7 point whatever million feels a little bit out of touch. Like, hey, where are we that we're doing at least a good job compared to either those around us or a good job to at least be on track? Like, what does that look like reasonably for a client?
Yeah, I would say reasonably for a client, we break this out and highlight it based on an age or a decade of a working career, right? And so starting in our 20s, we recommend or coach clients to where they should have an asset to income ratio of about 1 times their income. Okay, as far as assets that have accumulated. And these are going to be things such as retirement dollars, so anything in a retirement plan, brokerage account or something in an individual account, non-retirement investments, and even cash on hand, checking account, savings, certificates of deposits, whatever it might be cumulatively. This does not include any personal property or primary residence. So again, just your investable assets as well as cash on hand, something that would be what I would consider liquid in most instances. Well, as we move into the next decade of our 30s, again, that multiple is still 1x your income. Why? Because we recognize that, hey, there are capital requirements through these first 2 decades of a working career because of all the life changes that you may want to experience or that are going to arise and evolve. Now, when you get into your 40s, this is when we really start to hold you accountable and apply some pressure. Hopefully, we've been working with you for the past 2 decades, but when we get into our 40s, we want to help clients get to a point where they have about 3 times their income, right? So if we're looking at a household that's earning $200,000 a year, that means that they should have close to $600,000 in assets on their balance sheet, accessible for investments or set aside for delayed gratification with retirement.
And it's at this stage where if we've been making good decisions in our 20s and our 30s, we're starting to experience a bit of that compound curve, right? Our dollars are now making dollars for us, compound over compound, year over year. If we haven't done a great job saving through our 20s and 30s, this is where the pressure steps in. Right now, we really, in these peak earning years, have to play a little bit of catch up and put dollars away strategically and purposefully to reach some of these markers.
Correct. And I want to put a pin in that because I want to finish through our 50s and 60s, and then we'll revisit that statement. But in our 50s, the marker is really 5x your income. And then when we get into our 60s, 10x your income. So again, if you're making $200,000 a year, 10x that in your 60s, and that should be the minimum that we have set aside. Now, if we get to a point where we're measuring how much you have in an overall assets to income ratio and whether or not we're above or below our actual benchmarks, if we're below, this may not be problematic. And I think this is what most clients or investors need to hear is that, hey, it's really not about how much you have set aside. It's more about 2 things. One, again, what is your lifestyle needs or demands or requirements? Okay. And then 2, how much of your income is already going to be replaced in retirement from some sort of guaranteed income source, something that will be there month to month, year to year, things like a pension or things like Social Security. And so if you take a retiree whose income, annual need in retirement or monthly need in retirement is, let's just say that it's $100,000 and their Social Security benefit as a household between husband and spouse is about $60,000. Well, how much of their annual income need is being replaced by some sort of income stream?
It's 60% at that point. It's the majority.
It's over 50%, which again is a great feeling. And we've established a really strong floor. And so that just means that whatever assets we have need to fill the gap of replacing the other 40% that we need. And there's 2 ways to do that. One, we can make sure we have enough assets and put it in a prudent investment strategy that's going to provide us that extra $40,000 a year in interest income or dividend income. Or we're going to have to start to reduce our lifestyle in range, or maybe spend down more than just the dividends and interest. Maybe we're spending down dividends, interest, and principal of our investment accounts.
Now we can see where this is starting to get a little bit more complex and how to best fill the gap, how much of the gap should be filled, right? Discretionary or non-discretionary. And I think it's in this stage closer to that maybe 5 to 10 year range or window where we can truly lock in on those numbers more so as we've got the best idea of what's that burn rate going to look like and what's that replacement rate going to look like.
Correct. I've come across multiple instances where I meet with a client where they have relatively decent income during their accumulation years. I didn't meet them really until they were probably 5, 7 years out from wanting to exit the workforce. didn't have a ton of assets as far as what was in their retirement plans or even non-retirement investments. But from a lifestyle perspective, their lifestyle was minimal, maybe needing somewhere between $2,500 to $4,000 per month. And so mortgage was paid off, so there's no drag there from cash flow perspective, close to $300,000, $400,000 in investable assets. And then from a Social Security standpoint, the Social Security benefit at full retirement age was going to replace more than 50 to 60% of their income. And so you shouldn't feel insecure if you don't feel like you have enough in assets. I think it's more of a reflection in the mirror of, okay, what does my lifestyle need as well as what are my wants? And let's first make sure that we can replace the needs. And then if there's excess, then let's focus on the wants.
And I think that's where having a good financial professional in your world who can best frame what that looks like for you and your family can make a huge impact, right? Because we might speak to someone who's right on the edge of their retirement finish line. And if we run a simple needs analysis, it might spit back and say, hey, you're wildly underprepared. But if we have the best understanding of, hey, what does your world look like? What is your burn rate? What assets do we have available and what strategies are out there that we could leverage? Can look vastly different when it actually comes time to retire outside of just the numbers on an Excel sheet or the numbers in a vacuum.
And we work with other clients who have multiple millions of dollars, but their lifestyle is so big that they're at risk of potentially not having enough wealth set aside in order to provide the lifestyle that they desire, the lifestyle that they have now when they're in their quote unquote golden years. So the old saying is don't judge a book by its cover. That's what we're here to try to promote, is that, hey, financial planning as a whole needs to be humanized. This process needs to be humanized. There's a lot of behavioral science that goes behind this, and there's a lot of psychology behind it. And we don't want individuals to think that, hey, your life needs to be spent based off the output of a spreadsheet, which is really the precipice of today's conversation, because we started with what? A spreadsheet.
Yep.
So again, if you're feeling insecure about the amount of wealth you've accumulated up to this point based off of which decade or age you're in with your working career, that's fine. We're happy to have a complimentary consultation with you just to review and give you some high-level insights. And if it makes sense to establish a working relationship, then let's go and take those appropriate next steps. But Brady, I know we wanted to wrap up with one more thing as far as outlining the trajectory of an accumulator and how that segues into the deaccumulation phase and considerations that need to be thought of or at least looked into as you progress your way up the mountain.
And Michael, ultimately, I think that's where the most value comes in from having a financial planner on your side or financial professional on your side, is the name of the game, I'd say, in accumulation phase while individuals are still working versus distribution phase where paychecks are coming from net worth, is that the accumulation game is characterized by, I would say, the collection of dollars. What's the best way to put as many dollars in our pocket to grow them as best as possible and to essentially build this nest egg? But as you mentioned, when it's time to retire, where clients go to consider retiring, the amount of dollars on your balance sheet may not really point in a particular direction as to, hey, can I retire or do I have enough to retire? Truly, the name of the game when it comes to retirement is this idea of income.
Yeah, I would say if we were role-playing this and you were my advisor, it's important to me to know how much I have in assets and, what my return on investment is going to be. But I would say if I'm in retirement or approaching it, what I care most about is, hey, Brady, how much money do I actually get to spend in retirement? Because one thing that hopefully I know you're going to be coaching me into is that, hey, when I enter retirement, every day of the week is my favorite day of the week today. So if my favorite day of the week today is Saturday because I'm getting up and I'm going out to get brunch with my family or friends and, we're going to go run errands and we're going to spend money, that's every day in retirement because I have no other obligations or responsibilities more than likely. And so there's always an opportunity to go spend money. And I want to make sure that if I get to go spend money, that I don't have any sort of limitations.
Oh, absolutely. And I think that's where the coaching point comes from, right? I could say, hey, Michael, you got $10 million on your balance sheet, but you don't have enough income to support the lifestyle that you want. In that case, you can't retire or your retirement is going to be at risk. What I could also say is, Michael, you've only got $500,000 on your balance sheet in your mid-60s. But that $500,000 plus your guaranteed income sources, it covers all of your lifestyle. In that instance, you absolutely can retire because the name of the game is truly income.
Right.
So the focus for clients, at least in our coaching, is how do we accumulate dollars in as much volume as possible, as efficiently as possible? How do we put those dollars to work for us? But with this idea that moving towards and then into retirement, we're really playing a different game. And it's a cash flow or an income game. And so some of those decisions that we make along the way as an accumulator is to eventually prepare for the idea that we're going to have to turn our balance sheet into a true income source.
And the journey up the mountain is always different than the journey down the mountain, right? Both sides require different skill sets. And it's a matter of just making sure we're being as optimal and efficient and purpose-driven as possible. Because at the end of the day, the life you get to live in retirement will be indicative of how prudently you prepared during your accumulation phase. What proactive steps did you take to put more money onto your balance sheet as opposed to the balance sheets of other? And again, the retirement needs analysis is conducted in a vacuum. So there are risks that we know that need to be considered because life can throw curveballs at you. And again, that pretty analysis that's spit out in the spreadsheet could severely be different, right? It could be better, it could be worse, depending on life events that occur. It could be better in the sense that, hey, you just won the lottery and now you have a lump sum balance that hit your investable assets. And so it reduces the amount you're required to save over the course of the remaining years of your accumulation phase. Or, hey, you had a major medical life event that occurred and now you're going to need specialized assistance or care or oversight while you're in retirement. So now you hopefully were able to save more, or hey, it depleted some of your assets along the way. And so now you got to save even more aggressively. Again, there's so many what ifs, but we can't plan based off what if. We need to plan based off what we know.
So Michael, to summarize today's conversation, the big call outs, at least that I'm hearing, is asking that wide net question. Am I on track for retirement? Can often be a loaded question. And in many instances, when running the numbers purely in a vacuum, it's pretty discouraging to see, hey, what that road ahead or that mountain worth climbing looks like. But I think big picture, what really drives any retirement planning conversation is just a good understanding of what do I need today? What might I need tomorrow? And what's that look like between now and then? And then otherwise, it's understanding that the game up or the journey up the mountain is a much different one than the journey down the mountain. And putting things into perspective and having a good planner and professional on your side can make a huge impact in any decision, whether it be up the mountain or down the mountain.
That's absolutely correct. And again, there are things that need to be considered or planned for in a prudent and proactive manner because we just don't know what life is going to throw at us. So I would echo everything that you just shared, and I would even add that, hey, if you have any form of financial insecurity of where you're at today as far as your age, accumulated wealth that you've set aside up to this point, or maybe you've had an experience in the past with some sort of financial advisor that ran a needs analysis that just left you completely defeated, reach out to us. Let us know. Let's have a conversation. And again, if there's anything that we can do to be a resource in your corner, we want to be able to help you.
So that wraps up today's episode of Financial Fortitude. We hope that you're at least feeling a little more confident compared to when you jumped into the journey. But no matter where you are, we're here to help.
If you found this episode helpful, please take a moment to subscribe, leave us a review, and share it with your friends, family, and colleagues. Again, we're here to be a resource for others as well as yourself. You can also follow us on social media for more tips and updates. Thanks for hanging out with us today. Until next time, keep building your financial fortitude.
Thank you for joining us this week on the Financial Fortitude podcast. We hope you enjoyed the show and learned something along the way.
If you're looking for financial guidance that is personalized to your specific needs, we're here to help. Visit us at www.genesiswealthplanning.com to book a complimentary consultation.
That's it for today. Make sure you subscribe so you don't miss out on future episodes. And as always, please share with others you feel could benefit from the show. See you next time.
This podcast is for informational purposes only and is not to be construed as tax, legal, or investment advice. Although the information has been gathered from sources believed to be reliable, please note that individual situations can vary. Therefore, the information should be relied upon only when coordinated with individual professional advice. Guest speakers and their firms are not affiliated with or endorsed by Park Avenue Securities, Guardian, or Genesis Wealth Planning LLC, and opinions stated are their own. Guardian, its subsidiaries, agents, and employees do not provide tax, legal, or accounting advice. Consult your tax, legal, or accounting professional regarding your individual situation. All investments and investment strategies contain risk and may lose value. All scenarios and names mentioned herein are purely fictional and have been created solely for educational purposes. Any resemblance to existing situations, persons, or fictional characters is coincidental. The information presented should not be used as the basis for any specific investment advice. Michael and Brady are registered representatives and financial advisors of Park Avenue Securities, LLC, PAS. Securities, products, and advisory services offered through Park Avenue Securities, member FINRA, SIPC. Financial representative of the Guardian Life Insurance Company of America, Guardian, New York. Park Avenue Securities is a wholly owned subsidiary of Guardian. Consolidated Planning Group, Inc. and Genesis Wealth Planning, LLC are not affiliates or subsidiaries of Park Avenue Securities or Guardian. Michael Acosta's California Insurance License Number 0M50974 and Brady Hemmerly's California Insurance License Number 4353077.
6991809.1. Expiration 327.